Good morning, everyone. Welcome to this new webinar by the International Energy Agency in our program of capacity reinforcements on energy data and modeling for Zambia. So today we will discuss how to develop modeling and long-term planning for the power sector. And I will be joined by my colleague Yasmina Salan to present this topic. So just reminding you where we are in our online course. So we already discussed several aspects of how to do energy modeling. Yesterday we discussed in details how to look at the end use demand, taking the building sector as administration. Today we'll focus on power, and next week we'll have further discussions on the supply side of the energy system with the hydrocarbon and fossil fuel topics, and then we'll have other sessions. So without further notice, I invite you to jump to the www.menti.com website to answer some polling questions. Okay, so thank you very much for your answers. So it's interesting to see that you rate industry as a number one sector for electricity demand. It's almost the case in our data for the year 2019, but actually industry is number two and number one is residential. It's the two are very close. Residential electricity demand is at almost 80 terawatt hour, while the one for industry is at 75. So it's very close. Then we have services, which are at around half this value at 40 terawatt hour of electricity demand, and far behind agriculture and transport with less than 5 terawatt hour. So residential and industry are the two leading sectors for electricity demand in Sub-Saharan Africa, followed by services. So another question, which might seem obvious, but let's still go through it, is, in your opinion, can we expect the electrification of final uses in the future to decrease, to remain about the same as today, or to increase? Okay, so most of you think it will increase. Actually, it's the case. It will increase at global level, but with high regional disparities. In emerging countries, in regions of the world like Africa, it will increase a lot. In others, it would remain about the same as today. So it's really, we need to have a regional specific approach to this question. And no, sorry, we won't go for that question. Okay, we'll come back to other Menti questions at the break in the middle of today's webinar. So coming back to our presentation. So before my colleague Yasmin explains you more in details the power sector specificities for modeling, I'd like to share some analysis, some findings on the power sector based on our recent publication. So first one is why are we looking at the power sector today? We do that because it's important for the power sector is very important in the final energy consumption of all sources. If we look at the world, we see that power sector account for more than 20% of total final consumption, TFC, and of course with high variations across the subsectors, residential services being very electrified sectors. Then, when we look at the share of power sector in energy-related CO2 emissions, it's at almost 40%, which is a very good reason for looking at how this sector works and what is the situation. So this is the global picture. For Africa, we have the same dynamics and the same order of magnitude, although end-use sector are a bit less electrified than the global average. So looking at regional dynamics, here you can see the electricity demand region per region in 2019. If we look at the difference between 2019 and 2020, you can see interesting trends which are related to this very specific year with the impact of the COVID pandemic. So you can see that electricity demand in China has been rising, whereas it has declined in many countries. At a global level, we can say that global electricity demand has been relatively resilient to COVID-19 because it has only declined by 2%, whereas the global final energy demand was at 5%. And again, in economies such as China, electricity demand levels returned to pre-COVID levels very, very quickly. So this was the historical part. When we look ahead in all our scenario, we see electricity demand returning to growth very, very quickly in the early 2020s years. But what's interesting, it's again the regional dynamic. So here you can see how China would lead the growth and would see demand doubling to 2040, while India would be the region with the fastest growth. Electricity demand is expected to grow at 5% per year, which would make India the third largest power system on Earth and overtaking the European Union. In the case of Africa, we also expect a doubling of electricity demand between today and 2040. And when we look at the sources of demand growth, we see that the face of demand is changing. Sure, traditional sources of demand like electric motors in industry and household appliances continue to be the pillar of growth, especially in developing countries. But we also see emerging new sources of demand for electricity that relates to space cooling needs, that relates to digitalization and to electrification of transport. So this was on the demand side. If we look at the supply side, we also witness a very profound transformation of how electricity is produced. Looking at the last 2 decades, coal really had its reign. It was clearly dominating since generation from coal-fired plants were increasing more than any other source. But the future does not look like the past, and we expect solar PV to be the new king and to grow fastest in the coming 2 decades. So here you can see the blue bars, which are the change in global electricity generation over the coming 2 decades under our STEPS scenario. There is much more potential and room for higher growth, specifically under our SDS scenario, where solar PV becomes the primary mean of meeting electricity demand growth, and it means that the market will take off. Here you can see that solar PV would reach a value of 8,000 terawatt hour, which is 12 times the global solar PV generation we had in last year or in 2019. And reasons for this growth are solar PV cost declining all over the world, strong policy support, and cheap financing, making solar PV the cheapest electricity source in most regions and most countries of the world. For Africa, if we look at analysis we conducted in our Africa Energy Outlook, one good example can be to look at investment needs, and we anticipate that today Africa is currently home for only 4% of the global investment in the power sector, despite Africa is home to almost 20% of the population. So that means that in Sub-Saharan Africa, the power generation capacity per capita has really shown little or no growth over the coming 3 decades, while in India, in Southeast Asia, it has grown fourfold. So if we want to address the deficit of power infrastructure in Africa, this requires a significant ramp up in investment, and it would mean a doubling under our policy stated policy scenario or steps, and a further doubling in our Africa case scenario, where universal access to electricity is reached by 2030, as well as the GDP growth objectives under the Agenda 2063. And this number might look very high, $120 billion annual to be invested in the power sector, half of them for network and half for generation. But actually, if you compare this number in terms of how much of the GDP it represents, and if you compare to what other regions of the world have been doing, it seems achievable, because it's less than what India put on the table over the last 2 decades to electrify and to develop its power sector. So I'm stopping here with those first sense-seeking insights and results of recent IEA analysis, and now so I will give the floor to my colleague Yasmin, who will present more how power system work and how do we do modeling under power system. And again, sorry for a few small technical issues in the video recording we did. Please do not go to Menti, even though you are asked to under the video.
Hello, everyone, and welcome to this session dedicated to the power sector. My name is Yasmin Arsalan. I'm a power sector modeler and analyst within the World Energy Outlook team here at the IEA. So today, together, we'll look at the basic principle and characteristic of the power sector. We will first have a look at how it's functioning without wind and solar PV. Then at the end of the presentation, we'll come back to these newer technologies and see how they are impacting the power system's operation. As we all know, power systems are very complex systems. They have a multitude of actors, multitude of elements and interaction between them. I'd like to focus on the most important one here. So first, the demand side of things. You can see here the different centers where electricity is consumed, be it a household, be it industries and businesses, commercial facilities. Second, then on the supply side of things, where this electricity is produced. So this is the generation facilities. And third, between those two groups, you have the grid, transmission, distribution grids, and other related infrastructure, and the grid that connects those two broad groups. So this is for the grid connected element of power systems. You have, in addition, some off-grid elements. They can be divided between mini-grids and standalone systems. We need now to remember that this is a picture taken at one point in time. For example, regarding the national grids, traditionally, this has been only one direction flows from generation centers to demand centers. And now this traditional way at looking at flows is becoming blurrier and blurrier. You can see that now more and more consumers are generating their own electricity and injecting it into the grid. So this traditional unidirectional flow is becoming more multidirectional. So that is on the national grid side. On the off-grid side, we can think that some off-grid elements can at some point be integrated in the national grids. Mini grids can be connected at some point in time to the main grids. So this presentation, we will look mainly to on-grid system, and we will leave the off-grid ones to a separate webinar. Today, we will focus mainly at the supply side of things. We will focus really at the generation part of the power sectors. Of course, demand side is really important. Electricity demand level, electricity demand shape will really impact the power sector's operation and their evolution over time. Over the course of the year, over the course of a month, over the course even of a day, or even at a shorter time frame, will have impacts on the operation of power sector generation. So more on demand. We looked yesterday at end-use sector energy demand. Electricity accounts for a very important part of it. At the global level, we are talking about 1/5 of end-use sector energy demand that are met by electricity. And if we consider that electricity has a higher conversion efficiency compared to other fuels, other energy vector, then this share of useful energy is even much, much higher. Going forward, one very important characteristic to keep in mind when we are talking about electricity is that it cannot be stored in large quantities or for very long periods of time. We have some exception, thinking about large hydro storage facilities, for example. But the point is that it's very different from other energy commodities such as oil, such as gas, such as coal. The consequence of that is that we need to balance the system all the time. Electricity demand must be met at all time by electricity production. And for all this variation that we see over the course of the year or at even the second time frame. Until here, we looked at electricity demand. So this is sitting at this part of the world energy model. And electricity demand need to be balanced at all time, but by the electricity supply. So this is considered as an input to the power supply module of the model. In some other model, where final energy model is not as a part of the whole system, this would be considered as an exogenous input. So here we have final energy demand that is endogenous and that is feeding the supply part of power system. We also have a feedback loop from the power system to final energy demand, and this is reflected through the price of electricity. So electricity prices will determine also the competition that occurs between fuels in final energy demand section of the model. So if we look at this point with a very, very simple schematic, we can see how electricity demand is different from electricity generation. In electricity generation, we account also for the grid losses, the own use of power plants, some electricity trade that can occur between countries, between region. Let's think about power pools where trade can happen. So the total generation needs to be met by the producing facilities, which determines the electricity prices. And then there is this feedback to end-use sectors' demand. Now let's move on to the next section of this power supply modeling session. So we will touch upon more in detail what are the sub-modules of the power sector module in our model. So if we have a closer look at the power sector generation module, we have inputs flowing in. We need a lot of historical data, such as capacity by technology, by year. We need information on the generation mix, the fuel consumption. On top of that, each technology has a different feature. The cost, the capex of each technology will be quite important to drive our module. We have also learning rates, which will make this cost evolve over time as we have learning by doing. We need some grid elements, such as the length of the line, and also capacity factors. On top of that, some elements are linked to projections from other modules. So, as mentioned earlier, we need electricity demand from the demand module. On top of that, fuel prices that would come from the supply module and CO2 prices in regions that have applied these kind of policies. Talking about policies, we have constraints also. Other policies than CO2 pricing can be renewable energy targets, but other constraints can be market or non-market related or technical. And as output, we are able to derive capacity, the network length, generation, fuel consumption, cost, investment, and electricity prices that would then be implemented as a feedback loop for electricity demand module. Now let's have a closer look at this black box. When we model the power sector, we need to remember that this is a multitude of submodules that needs to be considered. From distributed generation to nuclear generation. One of these modules, for instance, combined heat and power and heat plants, will have heat demand as a driving element. Water is a driver for this desalination one. Renewables need to take into account the available potential for each location, etc., etc. And as an output of each of these very complex submodules, we have the evolution of capacity, fuel mix in terms of generation and use. We have the emission, we have the investment and prices. So this is a more detailed diagram of the power sector module. Here you can see that there are two central points in this module. We have the capacity addition mechanism on the left. So this is the module from which we derive what type of capacity needs to be built to meet electricity demand. So the inputs in white of these modules are investment assumption, prices, efficiency, historical capacity, and retirement. We also have in green some calculation that would have an important impact on this module. Electricity demand, obviously, we build this capacity to meet demand. And we will look at this module first, then we will move on to the dispatch mechanism. Once we have those plants, this installed capacity, how do they operate? So maybe before digging in, an important consideration to have in mind here. When we are talking about the needed installed capacity in a power system, there are two components. We build it to meet demand, but also because our power plants have lifetime. So existing plant today will be retired in the future. And so new capacity addition will need to compensate for these retirements and on top of that, increase to meet the new demand. So let's start with the capacity addition module. So we need first to remember a key characteristic of the power sector, which is that supply and demand must match at all times. And looking at demand, we have a constant variation over time. So here we can see the hourly electricity demand, and we can see how it changed over the year with strong variation among seasons, which would depend obviously on the country. If we could look at monthly changes, we see as well some variation. And during the week, we see higher demand during working days. And during the day, higher demand during daylight hours compared to nighttime hours. So to model power supply, hourly electricity model can be used. We have this kind of models here in the World Energy Outlook team for several regions, the United States, China, India, and the European Union. But this is quite a complex kind of modeling, and it requires a lot of data. It requires very powerful computing capabilities. So when we look at the annual granularity, we make some assumptions, some simplification to still consider the granularity, the time period granularity, but keeping it in a simpler way. A very common simplification is to reorder the hourly electricity demand from the highest point, the peak hour, to the lowest value. And this is what we call the load duration curve. It can be expressed in absolute value, or as you can see here, relative to the average electricity demand and in percentage terms. So for example, here we see that the peak is about 170% above average demand over the year. So this is how we proceed. We can divide this load curve in several homogeneous segments. And the most typical one being peak mid, and base. So 4 periods of time here, the highest one being the peak segment, the lowest, the base load segment, and in between, 2 mid-load segments. So given the evolution of electricity demand over the projection period, the evolution of total dispatchable capacity can be estimated through 2 steps. So first, the peak to average ratio. Remember this 170% above average that we saw in the previous example. So we calculate this peak to average ratio based on the analysis of historical data and the evolution of different end use, for instance, cooling needs or electric vehicles can make this demand peakier. Then to have more reliability on the system, it is not only the peak demand that needs to be met. We build the system to meet that peak demand, but we have a level of security. This is what we call the capacity margin. So an additional amount of dispatchable capacity to be sure that we have a reliable system, even if some plants for extreme reason like rupture of supply chains, etc., are down in a certain period of time, then we have this capacity margin on top of the peak demand to make sure that the system is meeting demand at all time. So coming back to the different time slices. So as we saw earlier, we considered a base load type of plant, mid load type of plant, and peak load type of plants. And for each time slice, the new additional capacity needs to take into account all these 3 different time slices. So we consider the net addition needed to meet new demand, and as mentioned earlier, the addition needed to replace the retiring plants. Back to the main diagram on power sector module and the 2 central points of power modeling. So we had a look at additions of new plants. Now we will look at the way to operate these plants once they have been added to the system. So if you look at this diagram, the main inputs to operate the plants are, of course, what is the installed capacity, which was an output. Outputs are in blue, an output of the capacity mechanism. Once we have capacity, then the main drivers would be fuel and CO2 price, efficiencies, historical capacity, maximum capacity factors. And the output of this is generation by plants, and we will see at a later stage fuel consumption and CO2 emission by plant type. So we're really focusing on this part of the model. We have several dispatch mechanisms available when we model how plants operate. This is really aiming at determining which plants, which technology will generate in which point in time, within the hour, within the year, given a number of constraints such as the availability and flexibility, the technical constraints of each plant type. So, given a certain level of demand and a certain amount of installed capacity, depending on the type, power plants generate electricity based on dispatching rules, usually on an hour by hour basis. What is important here is the utilization rate, meaning during a year, how often these plants operate. So in gray, baseload plants would operate generally with capacity factors or utilization rates around 80%. 80% of the year, baseload plant would be used to meet demand. Midload would be generally used 50% of the year, and peak load run very much less hours. Really, as you can see on the graph on the left, you see they're used really for peaky demand, and so they have generally much lower capacity factor, generally below 10%. Here in this example, we have 7%. So this is a very useful indicator, this capacity factor. It can be used in the modeling to add additional constraint on the maximum generation of a group of plants. For example, you could set as a constraint that gas turbine cannot be used more than X% of the year. This is used to simulate operational constraints and also grid bottlenecks. One of the most common and most efficient dispatch system is the merit order. So what is the merit order? This is an approach, a least cost approach based on variable costs. This variable cost, we look within each hour, which is the best suited plant, which is the least cost plant to generate. So we rank plants from the lowest to the highest variable cost, measured here in dollars per megawatt hour, also taking into account the maximum electricity that they can generate in that hour. This diagram shows the level of electricity demand on the x-axis, and it helps determine which plants will run, and the consequence, the implication is the price. For example, for baseload plants, the off-peak price would be determined mainly by nuclear, lignite, and steam coal during baseload hour, mid-load, and also for peak load demand. When we average this resulting price over the whole 8,760 hours of a year, we can determine the average electricity wholesale price, the average annual electricity wholesale price. So why is the dispatching mechanism important? This module helps determine a number of very important elements. So how plants are operated over time, how much electricity is produced by each technology, which plants will be generating, and then, and I'll come back to that later, the fuel use and associated emission. And we saw that just in the previous slide, the price. And to sum up, the result depends on many factors. So from the capacity addition mechanism, which plants are here in the system for each year of projection, what are the relative price of coal, oil, and gas that would impact the variable cost and therefore the merit order? Is there a CO2 price that would penalize the most carbon-intensive technology? and again, the changing level of demand. A quick illustration of the result of the generation module for a very specific case that we took from our World Energy Outlook 2019, and especially the focus on Africa. So here on the top, we can see the evolving demand over the period and for different scenarios, and how electricity is generated, what are the different sources of electricity in those three scenarios, the stated policy scenario, the Africa case. So we can see clearly that in the Africa case, demand increased almost eightfold, and here gas, wind, and solar are meeting most of the demand growth. Coming back to the diagram, we have now covered the two main components, addition of new plants and dispatch mechanism. To follow, I would like to focus on other very important elements of this power system, which is how much fuel is consumed by plants and the consequence of it, the CO2 emission by plant type. So once we have electricity generated from the dispatch module, one key element to consider is the efficiency of these plants. This is really key to determine the overall efficiency of the park and therefore the fuel use by type. The fuel use by type is really important when considering domestic production, considering energy security consideration, etc., etc. So how much oil would need to be imported, how much gas is very much linked to fuel use consumption in the power system. And from generated electricity, we derive that using efficiency of plants. So over time, technical improvements and with aging plants out of the park and more efficient new plants coming in, we can see the evolution. In the OECD region, this evolution is really minimal, but as you can see in China and India, as the demand is decreasing much faster, we have much more new plants coming in to meet that demand, and these new plants are generally more efficient, having a big impact on efficiencies in the park. Once overall fossil fuel use is determined from electricity generation using efficiency, we can derive the total CO2 emissions of the power sector. As you can see in the graph, the increase of electricity generation can be balanced by a decrease of the average emission per unit of electricity generated. This can be linked to two main factors. First, each fuel has a different carbon intensity, coal being the most intensive one, whereas gas is the lowest intensive technology. So a shift from coal to gas would have an impact on the CO2 emission per electricity generated. The second main driver is the efficiency. The efficiency would limit the fuel input per electricity output. So to pursue climate goals, CO2 intensity will need to be strongly decreased thanks to the massive deployment of low carbon technology, but also thanks to a shift to lower emitting fossil fuel technology and improvement of new technology, so they are more efficient.
Okay, so after this first subsection, we will take some questions. So I have a few. One is why is South Africa excluded from Sub-Saharan Africa? So at the IEA, we are really looking at the entire world. So sometimes we share findings at the global level, sometimes at regional level. In the case of Africa, we are able to isolate South Africa from Sub-Saharan Africa, or to include it in. It's just a question of what do we want to look at, what the scope we are considering. And in the first slide I presented, I wanted to focus on Sub-Saharan Africa without South Africa, because as you know, South Africa has a very developed power system. He's a very heavyweight that is changing a bit the trends that we observe in other Sub-Saharan African countries. But of course, we have data also for the entire continent, including North Africa and for South Africa. Another question was on what is the use case for heat demand. So this is something that we might find more in northern countries, where heat can be used in the residential sector or in the building sector for space heating. Here in France, for example, you have some buildings who rely for the space heating on networks of heat, and this heat can come from different sources, including combined heat and power plants, and also heat can be used for industrial purposes. So this is why we usually look at both power and heat. In the context of Africa, we are mostly looking at power only. There is another question on the peak to average ratio. So I would like to come back to some slide on this. So here has Yasmin just presented. You can see the sector, the electricity demand hour per hour throughout the entire year, and what we do is to convert all those dots into another type of chart with ranking them from the highest point. So here the highest point might be in end December, assuming this, for example, is a curve for Europe, where in winter, in the month of December, there is more demand for electricity. So this would be the highest point for electricity demand, and the lowest might be in summer, where the day lasts longer and there are less needs for lighting, for example, and less needs for no needs for space heating. So we rank all those points, and then we put them as a relative value to the average, and you can see that so the average would be the 100% line, and the peak is the top value, which is at 170%, which means that the very hour in the year with the highest electricity demand was at 170% of the average electricity demand in the year. So this is how we come with this 170% peak to average ratio, and then we use this information when we look at total electricity demand in the future. So remember, we want to know what will be the electricity demand and what will be the need for capacity to meet this demand. So we can make our predictions on electricity demand maybe based on annual values, but then we will look at this difference between the time where we will have the peak versus the average, and this is the 170%, and then we add capacity margin, and this is how we get numbers on what shall be the generation to meet demand at all time. I hope this answers the question, but happy to elaborate more. So there is a very interesting question on carbon pricing mechanism. I'm sorry, I don't know much about it. I know we are working a lot with South Africa on this topic, or to implement or to support carbon markets. What I know is that, as described by Yasmin, putting a price on carbon can really influence the dispatch mechanism and the choice in using one specific power plant rather than another one based on its emitting factor. Another question on nuclear. The question is from the IEA analysis. Do we envision nuclear plants being adopted in some parts of Sub-Saharan Africa to contribute to meeting baseload in future electricity generation trends? So here again, I don't have all the numbers in mind. As of today, there is one nuclear plant which is in South Africa, but I'm not sure it's fully used or operating today. We when we do Outlook, we analyze all possible technologies and type of plants. So I'm sure my colleague have been studying if nuclear would be one of the technology that could be deployed in other part of the continent. In the result, what we could see from some projections we shared is that there is we mostly expect other sources to grow, like solar PV, like wind, but also gas as a dispatchable and base load solution for generating electricity. Okay, so thank you very much for the other question. I suggest we keep them for my colleague Yasmin, who will be able to address them better than what I do. So I keep them open in the Q&A box. Now I like to move to another very quick poll questions. So please come back to your Menti website. So still using the same code. One more question we're asking yourself is, according to you, what is the largest electricity producing source in Sub-Saharan Africa, excluding South Africa? So again, we look at this specific scope in the year 2019. So we are proposing different sources of electricity generation, and according to you, what's the largest one? So the code is the same, and just reminding it's 72570343. In the meantime, I see there is one question on the methodology we employ in setting network capacity with high shares of variable renewables. We will come to that question in the second part, and Yasmin will describe how to integrate variable renewables. So thank you for your answers to the Menti question. This is a very interesting question and we've been asking it to different participants. You may know that this capacity building program, we also run it for Senegal, for Benin, for Ethiopia, for DRC, and depending on your national context, we received very different answers. because the electricity mix are very variable from a country to the other one. If we look at Sub-Saharan Africa without South Africa, the first electricity producing source is hydro by far, because it's above, it's more than half of electricity generated. Then it's gas for one quarter, then oil, and coal only has 5%. But this is a regional trend. In coal in South Africa would account for more than 90% of the electricity generated, and in some other southern African countries, it also has a significant contribution to electricity generation. But this is not the case in other parts of the continent. Then you would have countries like Ghana or Ivory Coast who would rely a lot on gas for power generation. You would have countries like Senegal where oil is making the bulk of electricity generation, and you will have Ethiopia, DRC, or Zambia, if I'm not wrong, where hydro is at almost three-quarters of electricity generated. Solar PV, along with wind, bioenergy, and geothermal, only account for 4% of the electricity generated. So now another question is, which source, according to you, has been rising the fastest since 2014? So we are not looking anymore at the first source in terms of stock and production. Today, we are asking what has been the fastest growth. I'm sorry, the vote was closed, but it's just open now. Okay, so most of you rank solar PV at the fastest source in terms of growth, and that is indeed the case. Solar PV has been rising at an impressive growth rate of 30% per year since 2014. That being said, it's also because solar PV is starting from a very low level compared to hydroelectricity, who has already important installed capacity. The number two source in terms of growth is wind. And actually, if we look at a longer period, if we look at the entire decade from 2010 to 2019, wind was the fastest growing electricity source with a growth of 50% per year. So again, when we look at the future, we anticipate solar PV to be the new king of electricity in all regions of the world, including in Africa. So thank you very much for your answers. Just to show you our results according to our analysis, which are all coming from the Africa Energy Outlook report, where here you can see how the electricity generation mix evolved since 2010 and how it could evolve according to our two main scenarios. And you'll see a very important rise of solar PV, of hydropower too, but also of gas as a source of base load generation. Okay, so now I'll give back the floor back to my colleague Yasmin to discuss with you more the economics of power system and then the integration of variable renewables like solar PV and wind.
So we already looked at some economic concepts when we discussed the merit order and variable costs. I'd like now to expand a little bit more on that. And so in this section, we will now touch upon some other quite important aspects of power system economics. One very important aspect is how to evaluate the competitiveness of the different electricity generating technology. So competition depends on several factors, of course, cost component, but also when the plant is used, the time of use, and where. For example, if there is a grid congestion in the specific location. And it also depends on the value side of things, the value of electricity generated, and prices, of course, which could be higher generally at peak demand time. A very common indicator that is used to estimate the cost of producing electricity is the LCOE, the levelized cost of electricity, representing the cost of technologies over the project's lifetime. And we can see some indicative values for some of these technologies in the screen right now. The LCOE is measured as average cost per output of electricity. So here, for example, in dollars per megawatt hours. This metric really does a great job actually at putting together all the various technology costs. So talking about the cost to develop, design, license a project, the capital cost to actually build the plant. But then, of course, over the lifetime, which can range from 20 to 70 years, you would have also to pay for operation, maintenance costs, as well as input fuel and CO2 prices when applicable. Of course, on top of that, you would have the financing cost along the way that we generally call the weighted average cost of capital. So this can be quite a significant and disparate set of costs. Would depend on the technologies. And we can see here how the LCOE really does a great job at putting them together in this general formula for calculating the LCOE. We have a more simplified form as well. So the idea now is not to look in detail at this formula, but I would like to highlight one point, that we have two main components: the variable cost that we use also in the merit order, and the fixed annualized cost. And these two components, they change according to the type of plant, and also the proportion, the relative importance is different depending on the technology. One quick example here to illustrate that point is to look at LCOEs by technology in the United States for 2017. Typically, low carbon technologies such as nuclear, wind, and solar PV, they have a high fixed cost and very low variable cost. On the other hand, gas, and to a lesser extent coal, are the opposite. They have high variable cost, and compared to that, relatively lower capital cost than low carbon technologies. Another point to highlight is that financing can be quite a significant proportion, especially for capital intensive technology. And if you have to pay a rate that reflects a very high market risk, then financing can be more important than the actual cost to build the plant itself. One of limitation of the LCOE, and especially in the simplified formula, is the capacity factors that are used is often fixed. So another very useful way to look at things is to see how the cost of power plants is changing depending of the amount of time these plants are used. So in the screening curve is what we call this way of looking at things. In the screening curves, you would look on the y-axis as at the fixed annual cost, and it would show how the cost would increase over time, over the time of use over the year, depending on how variable costs are evolving. So this really show different type of technology, and it's really helping us to see the least cost pathway, the least cost solution for each type of utilization, meaning at peak demand, when the numbers of operating hours are really low, up to the base load operation of power plants when they operate all the year 8,760 hours. So you can see this least cost path in the screen right now. What is also very clear with this graph is that the power technology, they really provide different services. So we can consider nuclear power and coal plants very well suited for baseload operation, the baseload category. So it actually makes sense to compare them in terms of LCOEs. But it would be very difficult to compare a nuclear plant and a gas turbine or GT, which usually provide peak power, as we can see here. Another point is that this curve is valid only for dispatchable plants, and therefore wind and solar PV cannot really be included. They run when the wind blows and the sunshine, so they don't really fit very well in this traditional categorization, baseload versus peaking plant technology. So the question is, for this technology, can we really compare the LCOE to dispatchable technology? So that's one of the limitation of LCOE, especially for renewable plants. So as mentioned, LCOEs are very widely used, and this is because they allow to present in one concise number the generation cost of a plant over its lifetime. There are, however, some limitations, and we really need to keep them in mind when we are using this indicator. I will focus on one of the key limitation here is it doesn't include the value of electricity generated. So basically, if you are an investor and looking at LCOE, you must keep in mind that it doesn't encompass anything on the revenue side of things. The second limitation is that making comparisons across different technology is complex or wrong. You need to go beyond and look at the screening curves as we did earlier for dispatchable technology. And this screening curve concept cannot be applied to renewables technology because of these categories between peak and baseload plants. So we really feel the need to go beyond this limitation. It does a great job, but we want to go beyond to overcome this limitation. And that's the concept that we've been developing here at the IEA with the value adjusted levelized cost of electricity. So the value adjusted LCOE is a new metric for competitiveness, and it really aims at combining costs and the value. And this is really the cornerstone of this concept, combining both. It is using information from hourly modeling of electricity demand and supply, so that we can have information on how the power system operates on the hourly level, but also prices. And prices are really important to reflect the value of producing electricity in any given hour of a given year. So back to the concept of Lcoe. On the one side, you have the LCOE metric that gives you the single cost number. And on the other side, you have the system value. And we can see here 3 broad categories. And these categories are kind of mirroring the new market design that we have seen emerging in many countries, thinking about the European Union, US, Japan, but many others are looking into explicit pricing of electricity services. So the main one is energy value, which represent the value of electricity production on a system at any time to meet demand. So in wholesale markets, which are widely represented over the world, this would be reflected by bids to sell electricity in a given hour. The second category is the capacity value. So it reflects the contribution to system adequacy. Capacity market exists in a number of regions with payment for power plants that can contribute to the reliability of the system. So basically, we can think of it that as being paid for being here when needed. And the third one is on the flexibility side, that encompass all additional services that really ensure the quality of electricity services. And this kind of services, they are generally valued through ancillary service markets that are also emerging in some countries. So the concept behind the Lcoe is taking these costs, these values, and merging them. So the energy value is the one that really has the most impact. Selling electricity is today the largest source of revenues in competitive markets. And of the 3 categories of values I showed earlier, this is the energy values that changes the most across technologies. So showing now some hourly outputs, with demand trends over the course of a sample day in the European Union in 2030. You can see these demand trends represented by the blue line. And you can see also the various supply technology that contribute to meeting that demand. So early in the morning, around 4 a.m., wind production is significant. And this is a time when demand is relatively low. So this leads to an excess of supply, and other plants are therefore ramping down. On the other hand, you can see also a need for a big ramp up of electricity output during the evening peak when people are getting back from work. So reflecting these changing needs over the course of the day, the market price changed quite significantly from 0 price in terms of excess to higher price at peak time. So when we do that, not only for sample 24 hours, but for all 8,760 hours of a given year, we can actually derive the price received by each technology. We can then average it over the year. It can be thought as if it was the revenues from selling 1 MWh of electricity on that given year. And that's what we call the energy values. It varies across technology. Again, dispatchable technologies, and particularly the most flexible ones, they are really able to capture those high prices at peak hours. So it means that their energy values is higher than the average of the system. And this, even if they run less hours. For this particular European system, you can see as well that wind and solar, especially solar, produce when it's less needed. So in that case, they have lower energy values. That's basically the idea of the energy value for each region for which we have hourly models. So this is the United States, the European Union, China, and India. We derive from hourly operations the annual energy value for each technology. And we do this for every year projected in our outlook and for all our scenarios. So from this hourly information, we can derive also the capacity value, so the contribution to system adequacy. Can you rely on this technology to produce electricity when the system needs it the most? Dispatchable power plants are generally available in all hours, except in extreme cases such as disruption in supply chain or extreme weather, for example. And they have high capacity value. They can generally contribute to something like 80% of the peak or even above for some technologies. And for variable renewables, it would really depend on the degree of variability and how the output of solar, the output of wind is adequate and coincide with system needs. So in this example of the European Union here, we can see that their lower ability to contribute to the evening peaks would mean a lower capacity value. A quick word on the flexibility value. This is really the most difficult one to represent. In the ancillary service market in Ireland, we have more than 20 products from primary, secondary, reserves, regulation, frequency controls, and it is very difficult for a global model such as the World Energy Model to represent that kind of details. So our representation is really derived from this real world existing ancillary markets value, and we take into account how it increased with the rising share of variable renewables as it is quite obvious that this flexibility values is linked to the ramp up of these energy sources. Now, keep in mind that this is an example, and this is very specific to the European Union demand and supply pattern. It would look very differently in a system where the demand peak is more aligned to, let's say, solar output. We can think of a warm country, a sunnier country, and in that case, the peaks occurs generally at noon, and this is very well suited to solar PV, which can be able to meet cooling needs linked to this particular system. In that case, solar PV would be able to capture at the same time peak hour high prices and also to better contribute to the adequacy and have higher values. Now, how do we put all the pieces together? For a particular technology, we start with the LCOE. Then we would simulate in a given year the energy value for this technology. We do that for all technologies, So we are able to compare to the average energy value of the system. So here, for this very illustrative example, we can see that the technology has a higher value than the average of the system. So it means that it is more competitive. More competitive means that we need to adjust the cost and reduce it to reflect that. So this is what we do. We take the difference with the average energy value of the system and make this adjustment on the cost side of the metric. Now on the capacity value, the contribution to adequacy here is relatively low compared to average. So that means that the technology is less competitive than others on that specific category. Less competitive, therefore more expensive. And now the flexibility value. Again, not a very high value compared to average, less competitive. We adjust by increasing the cost side of things. So we take all these three value adjustments, we apply them to the LCOE, which leads to the value adjusted LCOE, the Valco. So now to summarize the Valco concept, it does provide a more sophisticated metric of competitiveness. It includes these elements of value that the LCOE was missing, and it makes it robust across a wider set of technology. It is not perfect. A few of these limitations includes that they are not site-specific, so the network integration cost, for example, is not there, and it doesn't include externality costs that are not priced. So, for example, air pollution. The Valco is not the only metric looking beyond the LCOEs. For example, cost and benefits aspects are already taken into account in profitability calculations, such as the net present value. We have also some academic research looking into it. The US Energy Department, they also have similar metrics. In the real world, we have some application of very similar concepts in some auctions in Mexico, for instance. So to conclude on this concept, it's really part of a bigger family of beyond LCOE metrics that aims at providing useful information for energy modeler, system planners, and investors. And talking about investors, a very important outcomes of models is the amount of investment that is needed overall in the sector and for each technology type, as well as all the related infrastructure. So beyond spending on power plants that we would derive from capacity additions and their unit capital cost, we also see here that electricity networks also need to be expanded, maintained, and digitalized. So we model this network through a dedicated module that derives transmission and distribution grids infrastructure really needed to support the expansion of the power system and also modernize existing aging assets. We have additional constraints to the model that can be added to simulate more real-life investment constraints. And there are really important policy implication, market implication that can be derived for this investment to be really happening. Otherwise, the lights would not be kept on. So this kind of really coming back to the Valco, so that really highlights the need for investor and policymaker to have the right signal for investments. So the Valco concept is really important to improve the LCOE concept in order for them to have a clearer picture of competitiveness across technology, which is really essential to develop long-term plans and long-term goals. So I would like now to summarize the main calculation that we've been through: installed capacity, electricity generation, fuel inputs, CO2 emissions, but also kind of recall the relationships among these main elements. So we have capacity factors and merit order that are linking installed capacity and electricity generation. We have efficiency that connects electricity generation and fuel inputs. Fuel inputs and CO2 emission are related through emission factors. When we have gross capacity addition, then this helps us to determine the evolution of overall capacity by type. And we can calculate total investment thanks to unit investment cost. And all of these elements are related between them, and they are summarized using the LCOE metric despite its limitation. We have now reached the last part of our presentation on the power sector. And for this very last section, I would like to introduce the basic principle of the concept of variable renewables. What are their constraints? What are the solutions to integrate them into power system? So why are we looking at wind and solar PV technologies? The answer is quite easy. They really represent the biggest change and success story of the last 15 years. Solar PV is the new king. It's the most built technology over the past 3 years. It's the cheapest source of electricity in most countries over the world. And beyond these recent trends and historical trends, we see, looking forward, a greater role, a greater share of this technology to decarbonize power system in the future, to decarbonize the whole economy. But a point to keep in mind when we are talking about wind and solar PV is that the electricity generation, their output, is really depending on the underlying natural resources. And we can see on this slide how these outputs evolve over time because they are linked to the natural resources, they are linked to meteorological conditions. So this variation can lead to several consequences that can be summarized with really 3 main characteristics. That would be scarcity, abundancy, and variability. Scarcity is the situation that happens when these non-dispatchable renewables, these variable renewables, they do not provide enough generation to cover demand. So this requires other type of operator, other type of plant units to ramp up to meet demand. The second point, abundancy, is the opposite. It's when we have too much generation, too much output from wind and solar PV in the system, which leads to excess generation compared to demand. We saw an example earlier with the European Union. Then the third category, variability, is really the extent and the speed of the change of the outputs. For instance, the speed at which solar PV ramps up for the noon peak and ramps down when the evenings come, that needs to be compensated by other means of production. The impact of variable renewable energy sources would also depend on the level of deployment. At low level of penetration in the mix, the effects are really negligible. Power systems were built already to be resilient, to be able to accommodate the variability of demand. And when solar PV and wind share is low, the variation of demand from 1 hour to another is more important, has more effect on the system than this variability coming from solar and wind PV. But when we go beyond that, we begin to see some impact. Impact on total installed capacity. One key issue is the higher flexibility needs that would be needed from the system, the higher ramping requirements. There is an impact on the load duration curve, an impact on dispatch, on prices, and consequently on market design. And finally, an impact on how the network is used, on how the network can accommodate this variability. On the impact on the load duration curves, we first need to introduce a new concept, the concept of residual load duration curve. So we can apply all the reasoning that we discussed earlier to this residual load duration curve instead of the load duration curve that we saw earlier in the presentation. So what is this residual load duration curve? We take the hourly electricity demand, so here over the month of January, and then we would need to subtract the generation of the variable renewable energy sources. Here, this is solar PV. And the result is the light blue curve, the residual demand. Then, same concept as the load duration curve, we reorder the hourly demand from the highest to the lowest. And depending on the penetration of solar PV, you can see different impact. The biggest impact being the one with 60 gigawatts of solar PV. Looking at this example of 60 gigawatt and focusing on it, we can see that it generally has a main structure, but steeper than the original load duration curve, with big differences for base load and for peak load generation. This is a peakier load duration curves that requires less base load production means. We can have a clearer view of this phenomenon in this slide, where we can see how this would impact the total firm capacity needs. They do not change significantly overall, but as mentioned earlier, more peakier needs and less baseload needs. Now, zooming in a day, a sample day. So here again, the same concept of residual demand with the total demand in red And when we remove the solar output and the wind output, the result is the residual demand. What is really important in this zoom at the day level is we see very clearly the impact on the rest of the system. Here, when the solar output ramps up, then the rest of the system in grid needs to ramp down to compensate this. And the same happens in the evening. When the solar output is coming down, then the rest of the system needs to adapt to compensate for this. And this is the basic concept behind this very famous curve. So this is showing the impact of growing variable renewable production in California. So this is the duck curve. We can see the stomach of the duck getting bigger and bigger as the share of variable renewable production in California increased. And we can see how the neck is becoming steeper and steeper, an unfortunate conjunction of decreasing output for solar, but this is also combined with a peakier demand with evening peak. So now that we have a bit described this impact, how can we really put a quantification on this impact? First, a very concrete way of measuring it is, in case of excess, the amount of curtailment that is needed. And the impact would be also the number of hours with the near zero price, which we saw also earlier in the case of EU. One implication of this is that it would decrease the attractiveness in new projects. So if we don't tackle the integration project, new renewable projects would be less and less attractive to investors. And in that case, this would compromise the pace of change. It would compromise the pace of energy transition. So we need to avoid or at least limit the extent of this implication. And the good news is that we have several integration measures that are available to policymakers, to policy planners, and for markets. We can summarize this in increasing the flexibility of the power system, energy storage, demand-side management, as well as interconnection between demand areas, between countries, between regions, and the role of that would play network transmission and distribution grids. So these four categories, I'll come back to this in the next slide. You can see how these four main categories here displayed in that graph with different colors. For example, flexible generation solution is in blue. So we can see how these categories, they fit in the general flexibility landscape with decentralized options, the decentralized solution at the bottom, and utility scale solution on top. And these options, they are ranging from very, very short-term flexibility within the minute or even a second time frame. So this short-term is on the left, for which we can see, for example, storage that is quite well suited, and very long-term arbitrage, seasonal arbitrage, where, for example, grids would play a role, and flexible generation is a bit everywhere in this landscape. So we have seen that we have flexibility needs at the second time frame, at the seasonal time frame. One way of measuring flexibility needs can be also at the hourly level, and specifically the hour-to-hour ramping needs to fully integrate wind and solar PV and respond to change in demand. So here you can see those needs in 2019 in 4 major regions. Each dot here is representing an hour of the year. So for example, across the entire European Union, we can see that a very large upward change in dispatchable output from 1 hour to the next was needed, and about 20%. This happened when demand was rising and both solar and wind power were declining. So this is today, but in the future, flexibility needs will be much, much higher. The changing shape of electricity demand and the strong growth of solar PV and wind power, together, they are increasing flexibility needs in power systems around the world. So average hour-to-hour ramping needs almost double across most major power systems to 2040, with very much higher increase in some systems. We see a striking trend for India, where in certain hours, we will see the need for dispatchable sources to ramp up or down by well over 50%. The good news is we have those flexibility sources that I talked about earlier: power plants to electricity network, storage technology, demand side response measure. So coal and gas-fired power plants are today the main source of flexibility, and they remain so in the future. There are also some contribution from low carbon sources like hydro and nuclear power. But looking ahead, many power systems will need to rely on other means. Storage and demand side response will play a central role in flexibility, provided that we have the right policies and regulation to make this happen. And of course, on top of all these sources are grids. So solutions exist. They have a different range of impact, and the optimal mix of this solution would depend really on the characteristic of each power system.
Okay, so now we have some time for questions, and Yasmin just joined us to answer some of them. Hi, Jasmine.
Hello, Arnaud, and hello, everyone. I hope you had a good time with this modeling session. I'm very happy to answer as many questions as you might have. I saw there were already some. Arnaud, how do you want to proceed? I already start with the questions that have been asked before.
Yeah, please. Pick the one you want.
Okay. So there was a question if capacity margin is the same as reserve, is capacity reserve, and yes, the answer is yes. Is you just take a margin above demand to make sure that the system has a margin of security above this. So yes, it's exactly the same concept. Then there was a question related to the value adjusted LCOE, and if instead of taking the flexibility value on one side, it could make sense to factor it into the cost side of the value adjusted LCOE, and this is the same concept. Either you put it in the value side, or you reduced or increase in the cost side. So this would be a different way of doing the same thing, I would say. And for instance, the US Department of Energy, they do it that way. So it's just another approach that would lead to the same concept. There was a question, maybe we could come back to the slide on EU system, EU hourly system, if it was possible. So yes, if you can have one click. So coming back to this near zero wholesale price. So just to be very clear, the demand is the line in blue. So we see here that around 4 a.m., even if dispatchable units ramps down, you see it very clearly for coal, there are still wind that is producing a lot. So we have this excess. And in situation of excess, when the total production for all means is above demand, then it leads to these zero prices. We've also experienced sometimes some even negative prices, if that makes sense, but that's the concept. Of course, this energy will be curtailed. We could also imagine a system where wind would have to be curtailed in order to avoid those zero prices. But for the moment, in most systems, variable renewables have priority in the mix. So this, for the moment, this excess are happening. Maybe a little bit related to that, there is a question on how we take into account the fact that we are in dark, calm periods. So maybe if I can ask you, Arnaud, to switch to the slide just before the duck curve. I think it's slide 56.
Sure. Okay, here we are. I think. No.
Just after. Or maybe just before in your slide deck.
So
yes, this one.
This one.
Yes, this one is perfect. So a dark period is, let's say, midnight, 3 a.m. And a calm period is when demand is flattish. So this is a perfect moment where we see that we are not a dark time period. So this curve was built based on the hourly results. So when we want to model, we need to have the load profile at hourly level. We need to have the PV supply profile at the hourly level, and then we are able to derive that green curve. So we take into account when it's dark and when demand is low, and this would be the resulting curve that we would take into account to see how the rest of the system needs to work. The rest of dispatchable plants needs to work in dark, calm period, so a base load regime. There was also a question on the opportunity for power to X in Sub-Saharan Africa. So yes, the potential is very high. I can tell you more now because the results haven't been published, but we're currently exploring a scenario reaching a net zero emission at global level. And we see some power to X happening in this scenario in Sub-Saharan Africa. This would be not very significant in the first year of simulation because we would like to mainly focus on the access gap, and so the power and the reliability of the system first. So these are the priority, even in a net zero emission scenario. But then as we reach in that scenario full access in 2030, we would see now that the power sector is reliable, we would see a ramp up of power to X, and in particular from electrolysis and dedicated solar PV and wind. I don't know if we have time for other questions.
Yeah, maybe for one more, Yasmin.
Okay, let me look back. Yes, coming back to the EU, there was a question of which other country except EU are employing the value-adjusted LCOE. So as mentioned during the session, to derive a proper value-adjusted LCOE, we need the information from the hourly model. So we have this hourly model for the European Union countries, for the United States, for China, and for India. So for these countries, we are able to really derive all the information that is needed for flexibility value, energy value, and capacity value. For the other 22 region and countries that we model only at the annual level, we derive some proxies, some estimations based on those 4 regions. So we have also some additional information, even if we don't have them in the hourly model, such as our demand colleagues has been kind enough to derive hourly demand, even if we don't put them in the hourly model. So we have at least the demand information. We also have for additional countries some results regarding PV and wind profile, but otherwise we need to rely on some proxies to derive those values. And to be honest, having hourly models covering the whole world would be very, very difficult. The level of data that is needed is not available. In many countries, you wouldn't be able even to find this kind of information. But we hope to expand more our modeling capabilities to have a more accurate vision of competitiveness in covering more and more regions.
And in the specific case of Zambia and other countries in the region, if you have available data public that you are able to share, we would be very happy to look at them and to take them into account in further analysis. Thank you very much, Yasmin, for your answers and for your explanation today. We are running out of time. Thanks to all of you for your participation and attention to this session. We will meet again on Monday morning, 9 a.m. Lusaka time, to discuss the supply side of energy modeling, taking a deeper look at fossil fuel supply. So thanks to all of you, and I wish you a very good day and a great weekend.
Thank you. Have a very good day.
Thank you. Bye-bye.